Now, I do always like to start off the show with kind of a summary of what I saw happening in the market for the week. And of course, this is another interesting week as usual. We are actually down for the week right now. We've had 4 up weeks in a row. And I have been talking about all week the fact that we probably pull back. And the main reason is because we've just had so much run in such a short period of time. And there's several different indicators that I look at for that. One is called the Relative Strength Index, and I use the Wilder's version on a 14-day basis. And that's up above 70. It's at 75 early this week. Usually that means things are stretched out and going to pull back. I always use the rubber band analogy where things get too high and they come back. And so that's definitely what's happening this week. Market's down today, but today is a really unique day. This is the end of the options expiration day for August. $2 trillion worth of options are expiring today. So you get a lot of volatility on a day like today. I'd be careful to assign any real data to what's happening here. See what happens maybe next week. Although next week's going to be interesting too, just because you have very light volume right now, probably light volume next week because of vacations. And, I'm going to be gone. There's a lot of people that are out there. And so maybe we'll see some better information coming, in September. And that's a normal cycle that we kind of see all the time. But there are some interesting things that happened to the market this week. And I think this week, as well as last week, has been really about kind of the technical side, looking at the chart and what's happening with the chart, because it seems like there are some very important things happening. Number one, this is a little hard to see here, but that blue line that you see coming across there is the 200-day moving average. The red line connects the high points that have happened for this downward trend. And so the price actually got within 1 point of that blue line, the 200-day moving average, on Tuesday. And it turned down really immediately. If you look at the minute-by-minute chart like I do during the day, it just hit near there and came down. And so what happens is that there is an awful lot of basically short interest that tends to gather around a big number like the 200-day moving average. And so when it gets there, a lot of people are, shorting the stock. And when you short a stock, you borrow it from a brokerage firm, you sell it, and you hope that you're going to be able to buy it back at a lower price and give it back to the firm, and then you get to keep the difference. And so there's a lot of selling that comes on. Now, the one thing that's very interesting here is the exact opposite will happen when we break through that 200-day moving average. A lot of those shorts will have to start to cover. And when you cover, you're actually buying the stock back, and so you can give it back to the brokerage firms. And so all that buying obviously causes even more run-up. And right now, we still have a lot of short interest in the market. A lot of it has been covered in this run-up, and it's probably the main reason we've had this run-up. Hedge funds still have a very low amount of exposure to the stock market, and they've been shorting the market very heavily. So if the market breaks through that 200-day moving average, and if it breaks through that red line, that trend line, I think you're going to see a pretty big jump and some real power coming through that as far as that goes. But we couldn't do it this week, and I didn't think we would, and I mentioned that even in my daily videos at the beginning of this week, because we don't have enough power. We used that power up over the last 4 weeks. We broke through a very important barrier. I'll put that up there right now, actually, where this yellow line is. And you can see going back to the middle of June, we actually hit that line 16 times, right in that zone. And it finally got through, and then we had that nice little run up to the 200-day moving average. But we used up a lot of the energy, and the stretch that I'm talking about is really what happened. We kind of hit that, and now we're coming back. This is very normal. In my opinion, we should be going sideways, down, maybe even come all the way back down to that yellow line and that kind of thing. And that's a healthier market, in my opinion, than just breaking through, because you kind of stretch and stretch and stretch, and eventually it's like a rubber band. The more you stretch, the more resistance you have, the more it's going to snap back. So I'd rather see a period of time where the market just kind of goes sideways and essentially some of that stretch comes out of the market, and then we maybe blow up to the upside, hopefully. But this is the key right now, is just watching what's going on. So the 200-day moving average and that red trend line are at about 43.50 on the S&P 500. That yellow line, which is now support, is at about 41.70. So between those two numbers, the market can move up and down, and honestly, it won't mean much. There's just not a lot of information that comes out of that movement. Breaking up above, that means something. That's a very big signal, actually, for this downturn. It could signal the end of this downturn. If it breaks below, that could be signaling that we're going back to a new low. So very important information at the top and the bottom, but in between, not as much information, to be honest. There's be all kinds of news attached to why things went up or down or whatever. But really, right now, we're just kind of bouncing around between these two. I'd be a little bit surprised if there's going to be enough power next week to break through either one of these because we don't have huge volume in the last week of August, and we also have a scenario where the Federal Reserve actually has their big Jackson Hole meeting, and the Federal Reserve has been very much so in their latest interviews trying to talk the market down. This run-up that has happened for the market does not help the Federal Reserve trying to control inflation. The more the market goes up, the more people feel like they can spend, and of course that's part of the problem. They're trying to bring demand down to kind of meet this lower supply that we have as we kind of come out of this pandemic on the supply side. And so I wouldn't be surprised to see a fairly anemic market next week just because the Fed's going to be out there as far as that goes. But the 200-day moving average is moving down closer and closer to the market. That trend line is moving down. They're actually probably going to converge together at some point in time. And so there will be some point in time where it has a chance to break through the up or the down. So I think this is going to be a really interesting time frame. It's really important right now to be kind of watching what's happening. If it breaks above and breaks out, you can maybe be fairly confident that maybe if you want to get a little bit more aggressive or whatever it might be, it's not a terrible time to do it. It's a good time to maybe invest some cash or some bonds that you might have that you want to put in the market. If it breaks below that yellow line, below that 41.70, then you probably want to do just the opposite. Get more conservative, maybe even have some of your stock market exposure reduced, use some treasury ETFs, those types of things, because the downside could be tremendous here too. So the big battle right now is the same battle we've had all along. It's just one group looking at this and saying, the market's going to go up because the Fed is already raised rates enough. We're seeing commodity prices come down. Inflation's going to come down a lot faster than people expect. And the Fed's eventually going to be actually stopping raising rates or even lowering rates. And because inflation's going to be under control faster than people think. The other group thinks just the opposite. The Federal Reserve is going to aggressively go after, the interest rate increases, no matter what it means to the economy. And then, of course, that would create earnings degradation and big recessions and those types of things. And so there are more people, in my opinion, especially the big money managers, that believe this market's going to go down. The short interest on individual stocks is in the 84th percentile right now, which is very high for, that's way above average. And so there are a lot of people that think the Fed is going to have to raise rates more and that inflation is going to be very sticky. So we'll see who's right. The price will tell us what's happening over a period of time. But a lot of this run-up has been, caused because that big group that thought it was going to go down got out. They shorted the market. It just left the people who thought it was going to go up because inflation would come down. They start to run it. Everybody's covering their shorts. And, man, you end up with a big run here. And is it enough to really continue? Maybe, especially if it can break through the 200-day moving average, because all of a sudden they're going to be more short covering, and pretty soon people just see this as a big jump. We did get over the 50% retracement last week, which is a big deal. So that means from the top point that you see there in January to the bottom point that you see in June 17th, we have made about half of that back. Since World War II, when we make back half of the money, we have not had the market go down to a new low, even once during one of these bear markets where you have more than a 20% downturn. So anyway, there's some good things happening. There's some things that could be concerning that are happening. Mostly they're, I think, good at this point in time, so we'll have to see how this plays out. But anyway, that's what's happening this week. Glad I got a chance to talk to you. Looking forward to talking to you again in September. Again, I won't be here next week. I won't be doing the daily videos. I've done, them pretty much every day since the 22nd of March 2020, with a few different breaks here for vacations. This is another one. So look forward to talking to you again in 2 weeks.